Welcome back to Iron Financial. This is the place where we help you forge a stronger portfolio by cutting right through all the market weakness. I'm your lead analyst. Today we are putting a brand new heavyweight under the microscope, Medline, ticker MDLN. Now they just dropped their very first earnings report as a public company. And let me tell you, the numbers have Wall Street completely split down the middle. So we're here to answer one central question. Is this newly constructed house a fortress, built on a rock-solid foundation of growth, or is it just a house of cards, ready to collapse at the very first sign of trouble? We are going to do the heavy lifting for you, we're going to analyze the structure piece by piece, and we will give you our final verdict. But before we even lay the first brick, my colleague, our market skeptic, has a few questions about the blueprint.
That's right. My job here is to ask the tough questions, the ones you should be asking at home. Look, on one hand, you've got this absolute giant, a fresh IPO flexing its muscles with these unbelievable sales numbers. The headlines, they all want you to believe this is the next unstoppable growth story. But when you look just a little bit closer, you peek behind that shiny facade, you can see it stumbling right out of the gate on profitability. So, what is the real story here? Is the market seeing a powerful growth engine and pricing it correctly? Or is it completely ignoring some massive foundational warning signs that could bring this whole thing crashing down? That's the real conflict, and that's what we need to solve today.
In this slide right here, this captures the entire problem perfectly. It is a two-faced report if I have ever seen one. On the left side, you've got revenue. A solid beat, no question. They sold way more products and services than anyone on Wall Street thought they would. That's the strong, confident face they want you to see. But then you look to the right. You see earnings per share, the bottom line. The part that actually matters for profitability, for shareholder value. And it wasn't just a miss. It was a massive, colossal miss. This isn't some small rounding error we're talking about. This is a story of two completely different companies wrapped up in one single earnings release. One is growing like a weed and the other is just bleeding profit. So which one is the real Medline? That's exactly what we're here to figure out.
Okay, so to get to the bottom of this, we're conducting a full structural inspection. Think of it that way. First up, we're going to assess its reputation as an IPO powerhouse and really dig into why this report matters so much. Then we'll examine the steel beams of the bull case. We're calling that forging the top line. But then we're going to bring out the magnifying glass and look for the cracks in the foundation. After that, we need to analyze the hurricane that's brewing on the horizon, the tariff overhang that threatens the entire structure. We'll check in to see if what Wall Street thinks lines up with our findings. And then finally, we're going to deliver Iron Financial's final verdict. You're going to want to stick around for this one.
All right, let's get into it. Section 1, the IPO powerhouse. To really feel the weight of this report, you have to understand the context here. Medline just went public back in December of 2025. So this isn't some old, battle-tested public company with dozens and dozens of quarterly reports for investors to comb through. No, this is their debut. It's their first ever report card under the full, completely unforgiving scrutiny of the public markets. Every single number, every statement from the CEO, every piece of guidance is being dissected right now to set the tone for the future. For a company of this sheer size and importance, this first impression is an absolutely critical test of its structural integrity.
And make absolutely no mistake about it, this is a giant. This company is a behemoth. Medline is the largest provider of medical, surgical products and supply chain solutions in the entire United States. Just let that sink in for a second. They are essentially the circulatory system for American healthcare. They are pumping the essential supplies, the lifeblood, to hospitals, clinics, and surgery centers all across the country. This is not some scrappy little startup trying to disrupt an industry. This is the industry. And because of that scale, the stakes couldn't possibly be higher. So when a company this critical to our national healthcare infrastructure goes public and then immediately posts such a confusing, contradictory report, well, we have to pay very, very close attention. There is just no room for error when you're this big.
Okay, so let's move on to Section 2 and see how this thing is built. We're going to start by forging the top line. We are going to construct the bull case from the ground up, piece by piece. So if you're an optimist on Medline, if you really believe in the long-term story, this is your argument. It all starts with those powerful, undeniable top-line numbers. This is the solid steel frame that the entire bull thesis is built on. And you have to admit, just at first glance, it looks incredibly strong. Let's examine each component of that frame right now. So let's start with the cornerstone of the bull case, which you can see right here. $7.8 billion in net sales for a single quarter. I want you to just let that number really sink in for a moment. This is not just a figure on a spreadsheet, it's a direct reflection of their deep, almost unbreakable integration into the American healthcare system. It's a massive, load-bearing pillar that shows thousands upon thousands of hospitals and clinics across the country are writing enormous checks to Medline month after month after month. This is the kind of revenue base that commands immediate respect on Wall Street, and it serves as the primary foundation for any argument you could possibly make in favor of the stock.
But it's not just a big static number. This company is growing, and it is growing at a blistering pace. We're talking about a nearly 15% year-over-year increase in fourth quarter sales. Now, for a company of this magnitude, achieving that kind of growth is like trying to turn an aircraft carrier on a dime and then slamming on the acceleration. It just demonstrates immense momentum. It tells you that they are not just holding on to their dominant position, but they are actively taking market share away from smaller competitors. This kind of top-line acceleration, especially in a sector that's not exactly known for explosive growth, is precisely what growth investors are hunting for, and it's a powerful testament to the overwhelming demand for their services.
And this right here brilliantly illustrates where all that future growth is coming from. $2.4 billion in new customer signings in 2025 alone. This is the pipeline. This is the backlog of future revenue being loaded directly into the system. This number is a critical forward-looking indicator that tells you that the growth we just saw isn't just a fluke, it's not a one-time event. It proves their sales engine is firing on all cylinders, and that the structural integrity of their growth story has been reinforced for years to come. In fact, management expects to recognize about 65% of this new business in 2026, which provides a huge, already built-in tailwind for revenue moving forward.
And here's the final piece of the bull case. They're not just growing recklessly. They are actively fortifying the very foundation of the company itself. With the money from the IPO, they took $4 billion and immediately paid down high-interest debt. This chart shows you the incredible result of that move. Their net leverage ratio, which is a key measure of debt relative to earnings, it dropped from a pretty concerning 4.9 times all the way down to a much more manageable and healthy 3.1 times. This is a fiscally responsible, strategically brilliant move. It strengthens their balance sheet, it reduces their interest expense, which flows straight to the bottom line, and it gives them tremendous financial flexibility for any future investments or acquisitions. They are building this house on a much more solid bedrock of capital.
Okay, that all sounds great, doesn't it? A beautiful steel frame, a massive revenue base, a strong financial foundation, but a skyscraper with a perfect frame is completely and utterly useless if the floors are made of plywood. So it's time to start looking for the cracks in that foundation, because all the revenue growth in the world doesn't mean a thing if the company can't turn that revenue into a profit. So now we pivot to the bear case, and believe me, there is a lot to expose here. That shiny exterior is hiding some very serious structural problems.
And here it is, the first major crack, and boy is it a big one. A loss of 1 cent per share when Wall Street analysts were confidently expecting a profit of 24 cents. That is a massive 25-cent miss. This is the number that sent a shockwave through the market and caused the stock to sell off hard. It is a gut punch to the bull case. There's no way you can spend this. While they are busy celebrating all their sales growth, they completely failed to manage their costs, and profitability just fell off a cliff. This is not a hairline fracture you can just patch over with some good PR. This is a significant, gaping, structural flaw that appeared on their very first public report card. Let's break that down even further, because that headline miss doesn't even tell the whole story. This table puts it in stark relief. Just look at the two opposing arrows. Net sales, the top line, are soaring, up almost 15%. Fantastic. But look at the bottom line, net income. It absolutely collapsed, down a staggering 37.7% from the same quarter just last year. So how is that even possible? That's the question every single investor should be screaming right now. How do you sell $1 billion more in product and yet you make over $100 million less in actual profit? This is the core of the bear case. The business model is leaking money, and the more they sell, the worse it seems to get.
So the crucial point here is understanding where all that profitability is disappearing. And this slide, this shows you exactly where the leak is. We're calling it the gross margin squeeze. Gross margin fell from 27.3% all the way down to 24.6% in just 1 year. That is a 270 basis point compression. That's 2.7 percentage points, which is a huge decline in this business. For every single dollar of product they sell, they're keeping nearly 3 cents less than they did just a year ago. And when your sales are measured in the billions, a small change like that adds up to a catastrophic loss of profit. This is the source of the rot in the foundation.
So the big question is, why is this happening? Well, the company gave a whole laundry list of reasons or excuses, depending on your perspective. Higher cost of goods sold? Sure, that's happening everywhere. Investments in headcount to support their growth? Okay, that's understandable. One-time IPO expenses? Fine, that's a temporary issue that goes away. But the big one, the elephant in the room that is not going away anytime soon, is that second bullet point right there, tariffs on imported products.
This is the persistent external pressure that is absolutely crushing their margins, and it's the single biggest threat to this company's long-term financial health. And that brings us right to Section 4, the tariff overhang. We have to isolate this issue because it's not just another line item on an expense report. This is a massive external force being applied to Medline's entire business model. I want you to think of it as a constant Category 4 hurricane just battering the walls of the house they're trying to build. It doesn't matter how strong your foundation is. It doesn't matter how solid your steel frame is. If the store outside is strong enough and lasts long enough, it can bring the whole thing crashing down.
Right, and just so we're all on the same page here, let's be crystal clear about what we're talking about. A tariff is simply a tax on imported goods. That's it. Since Medline sources a huge portion of its products from overseas, these tariffs directly increase their cost of goods sold. And they are then stuck between a rock and a hard place. They have two choices. Either they eat the cost and just destroy their own profit margins, or they try to pass the cost on to their customers, the hospitals and clinics, and risk losing business to their competitors. It is a lose-lose situation, and it is putting their entire profitability model in a vice grip.
And this slide puts a number on that hurricane's force. The sheer weight of this problem is staggering. This is not some small, manageable number we can just brush aside. Management estimates the annualized net impact of these tariffs, even after all their mitigation efforts, will be approximately $490 million. Let's just call it what it is, a $500 million headwind blowing against them every single year. This is a direct, crushing weight on their profitability. For context, their entire net income for this past quarter was only $180 million. The annual tariff burden is more than double their quarterly profit. This is an enormous structural tax on their business that they have very, very little control over.
And, if you want to know how management really feels about this problem, you don't even have to guess. You just have to listen to their own words. On the earnings call, the CFO, Mike Drazen, he said this, quote, "It feels like we're back in April of 2025 all over again." That is not a statement of confidence. Not at all. That is a statement of deep uncertainty and palpable frustration. It signals a complete lack of visibility and a lack of control over a critical cost variable. So when the CFO is publicly telling investors that they feel like they're flying blind on a $500 million cost item, that should be a massive red flag for you. The people who are supposed to be steering the ship don't even know where the storm is headed.
Okay, so we've laid out a very strong bull case built on a foundation of growth and a very, very scary bear case focused on collapsing profitability. So let's move to Section 5 and see how the professional analysts on Wall Street are processing this two-faced data. Are they buying the growth story and just ignoring the storm clouds, or are they selling the margin collapse? Let's take a look at the market consensus. And what we're seeing is a market that is overwhelmingly positive, but with some notable and important hesitation. You've got 23 analysts combined with either a buy or strong buy rating. They are clearly focused on that massive top-line growth and that new customer pipeline. But look at that hold slice. 5 analysts are staying on the sidelines. They see the same cracks that we do. So what does this tell us? It suggests that Wall Street sees this as a show-me story. The bulls are betting that the powerful growth engine can eventually outrun all these margin pressures. But the skeptics on the sidelines are essentially saying, hey, we see the storm clouds, we are not willing to buy into this story until we see a clear forecast that the tariff hurricane is finally dissipating. So while the overall sentiment is bullish, it is not unanimous. The cracks are visible even to the pros.
Which brings us to our final section. It is time for Iron Financial to do the heavy lifting. We've inspected the blueprints, we have stress-tested the materials, and we have analyzed the external pressures. So now it is time for our final verdict. Is Medline a generational buying opportunity built on a rock-solid foundation of growth, or is it a value trap with fatal cracks hidden just beneath the surface, just waiting to give way?
So it really all comes down to this. On the left, you've got the bull case. The foundation looks solid. You have massive 14.8% sales growth, a $2.4 billion pipeline of new deals, and a fortified balance sheet with leverage down to a very healthy 3.1x. But then on the right, you see the cracks in the armor. A huge earnings miss of 25 cents per share, net income collapsing nearly 38% despite higher sales, and a crushing $500 million tariff headwind with absolutely no end in sight. You have to weigh these two sides against each other.
So here it is, the definitive Iron Financial verdict. Medline's growth engine is undeniably powerful. The top-line momentum and the customer acquisition are absolutely best in class, and their market position is formidable. However, that tariff overhang creates a significant and unpredictable structural risk that you simply cannot ignore or wish away. The best way to put it is this. The foundation of this company is strong,
but the house is being built in the middle of a hurricane. So the question you have to ask yourself as an investor is not, is the foundation solid, but rather, do I want to own a house, even a well-built one, that's in a hurricane with no clear forecast? For us, at this time, the risk of that storm outweighs the strength of the foundation.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.